The UK referendum obviously is coming up fairly quickly after the Fed, and the Fed does take international events into its equation there. You know, I think though deep down that they are mostly looking at what's happening in the domestic market. If there's a big shock, then they might shift their policy focus, but really it's what's happening in the domestic market that's the key driver. And as we saw, you know, some of those job numbers have been looking good for quite a long period of time. Inflation is showing some signs of picking up, and you know that kind of balance of risks makes us think that it's more likely that the Fed does actually look to hike in June.
See, that doesn't make sense to me when you've got Brexit coming, the key vote coming just about a week or so after the FOMC meets. The emerging market countries that I spoke to this week have been very concerned about depreciation of their currencies, fund outflows, whether this could be exacerbated by further Fed moves. So surely buying a little bit more time, even if it's July or a little bit later on.
Look, I think you can always make the case why you should delay the move. I mean, I think we saw that all through last year. We saw it in June and then September last year, and we eventually had the hike in December. Now, with regards say EM currencies and those sort of things, that we've been waiting for Fed hikes and the Fed hike cycle to really start since May 2013. So I don't think people can really say that the market isn't ready. I think, yes, there is volatility, inherent volatility in a lot of these EM currencies. Is that going to make the Fed, you know, pull back? I'm not convinced. You know, even if you think about it, the last few months, you've actually had a pretty good run in those currencies. The dollar's actually come off a fair bit. So in that sense, you know, maybe they're not as constrained as they were back in March when the dollar was actually a bit stronger.
Dominic, the numbers are all right at the moment, but there's as many averagely bad numbers as there are averagely good at the moment. I mean, we've seen some, you know, the ADP, for instance, not particularly impressive, but the non-manufacturing ISM this week I thought was pretty good, actually, and the employment component was very respectable. In fact, Goldman's have upped their forecast on the back of it. What's the rush? Why the rush to hike so much when the data's just so oscillating? There's some good stuff, but there's a lot of bad stuff, and most of the risks appear to be to the downside. Why are they rushing?
I don't think they are rushing. When you look at the time they've taken from when they really were saying they were going to start hiking to where we are now, it's been a pretty gradual process, and they do keep emphasising that gradual process. Look, there are good reasons why they may not hike in June, like you say. So I don't think it's going to be a rush process anyway. We've got 2 hikes priced in for this year from our side of things, but it's going to be very gradual, it's going to be very steady. I think really the question is why do they want to hike? Well, I think they do want to see some normalisation. They want to show the markets that the economy is recovering. They can move on to a more of a normal strategy.
If wages is the key, sorry to be a bore, and I know Jeff was getting in here as well, but if wages is the key, and I'd say I've looked at the US Bureau of Economic Analysis, I've been looking at the Bureau of Labour Statistics, I've been trying to really do some work behind the figures. And in any metric, we're not racing ahead of historical norms. We're slightly below where we probably should be at this stage of an economic recovery. So I don't see where the pressure is.
Yeah, well, look, the Fed always has to act in advance rather than react to the data. So you have to, you know, look at the forecast, look at what the Fed is expecting to happen on the wage number. So look, what has happened is important. It is an important indicator. But with the unemployment rate at 5% or so, that's historically low levels. That's generally associated with signs that wage pressures will pick up in the future. Sure. So I think, you know, in a forward-looking basis, the argument could be made and has been made by the Fed that these are the kind of things they're looking at.